Well, continuing our instruction in quantitative methods, we have our reading on technical analysis. So let's get right to that. What are the principles and assumptions which underlie technical analysis? Well, that stock values are determined by supply and demand, and I don't think we can argue with that. And these are driven by both rational and irrational behavior. That would be difficult to argue with as well. What technical analysts do is they use prices and trading volume. We're talking about just using market information to try and analyze the change in supply and demand and predict security price movements. Now, there's an underlying assumption that securities prices move in trends that persist for long periods and patterns that repeat themselves in predictable ways. So this is their basis for future prediction with technical analysis. So we can differentiate this from fundamental analysis, where we're looking at intrinsic value. We're looking at ratios, we're looking at cash flows, we're looking at asset values, estimated growth rates, and all that sorts of stuff. So with technical analysis, we're just using past trade prices and volume to see the ebb and flow of supply and demand and try and forecast future movements because we think certain patterns and trends repeat and are persistent. So what are the advantages of this? Well, one of the claimed advantages of this is that it's based on trade data rather than accounting data, and accounting data can kind of be fudged around, as we know. It can be used for assets with no cash flows. Actually, some of the early technical analysis was in Japanese rice markets, where rice has no cash flow. It only has a future price that you can sell it for. Same thing with gold, copper, anything like this. And you don't have to learn accounting. So these principles for the commodities, assets with no cash flows, we can expand those to assets that do have cash flows. And not learning accounting is a big benefit, I think, to specializing in technical analysis. But what are some of the disadvantages? Well, if you don't have liquid markets, you don't have that same kind of price information, so that would put technical analysis at a distinct disadvantage. It may not work in markets that are subject to manipulation, central bank currency intervention, changes in monetary policy, things like that. With bankrupt companies, the stock price is zero, so we haven't got any repeating patterns there to look at, and they won't work if markets are weak form efficient. Maybe I should underline this. You remember our discussion? I guess you may have not seen it already, but we will discuss in the curriculum the idea of weak form efficiency. Weak form efficiency says you can't use market information in order to gain an advantage, beat the market on a risk-adjusted basis on average. And so if that's true, if markets are efficient, then there is no value to technical analysis. So that's the point that's being made here. Now let's look at some of the charts and tools that they use in technical analysis. A line chart just connects the closing prices like this. A bar chart, each bar shows open, high, low, and close for the period. So it's a summation of the trading. It could be for a day, you could put that weekly or whatever. So you see the open and the close, and then the height of the bar gives you the whole range of prices over that period. The volume chart, we often run that across the bottom to show that the volume that went on each of these moves. So if you see a price going up, you can look down the bottom of the chart and you see if it went up on high volume, indicating a whole bunch of buying, or if it went up that much on low volume, then the indication is that, well, there's been a change in the perception of value there, so it didn't take much buying to get that price up that far. So we use those pieces of information in conjunction with each other. Well, now we've got candlestick charts, one of my favorites, and see they've got a lot of information in here. This one on the right is in black, okay, and that means that it fell. Close was lower than the open. Here's the close down here, here's the open. Over here, the close, it rose over the period from the opening at the period to the close, and that's in white. So that's an up move. And then we have the range, the high and the low over that period that we can see at the ends of the candlesticks. So a way of summarizing information again. Here's some other ways that technical analysts have used some other things they have used, other ways they've found to analyze price movements. On the left, we have a point and figure chart. We've got X's when those stocks are going up and O's as they go down. And when they reverse and go back up, we start doing X's again. And when they start going down, we go to the next column. So one thing to note about the point and figure chart is that this is not strictly a timeline down here. Here we have a whole lot of down trading days, and here we just had a couple of down trading days before it turned around and went into an uptrend. Or I could say trading periods. It might not necessarily be days, but probably is. And on the right, we've got those candlesticks. You can't see them all that well on the slide, but you get an idea about how you might look at a candlestick chart over time and see the high, low, close, and whether it was a down move or an up move and what the range was there. Now, trend lines, well, which one of these is an uptrend? Now, I knew you could get that one. It's this one on the left. There's our uptrend line. If we draw a trend line on the right, it's going to be a down. Now, the down line, we've connected the highs, right? Like it's bumping against that, but then heading back down again. And on the uptrend, it's kind of like it's bouncing off of it and continuing its journey upward. So there's a lot of noise in stock prices. There's a lot of moving around just from liquidity, rumors, headlines, whatever it is. And so recognizing the underlying trend is one of the things that is sometimes difficult to do, and recognizing when, where trends change from down to up or up to down. And certainly those are some of the most significant points that it's valuable to identify. The idea of support, remember I said that stock in the uptrend was kind of bouncing off that uptrend line. It was supporting it. So support is price where buying pressure limits a downtrend. Like, hey, if the stock gets down to here, buyers come in. We've seen that time and time again. That would be a support range. And a resistance range is a price where every time it gets there, people start selling large chunks of stock. So selling pressure limits an uptrend if there's resistance. So examples of support and resistance, well, we saw that trend line going up as an example of support, and that downtrend line as being an example of resistance. Is that right? Yeah, I think so. It kept bouncing off resistance and continuing down. Old highs, old lows may have psychological importance for investors. People may have been waiting 2 or 3 years to get out at the price they paid for it. Okay, the old high, if they bought at the old high, and that just means that could be an area of resistance because there's a lot of stock out there that people are more than willing to sell if it gets back to the price they bought it at. So that could be some underlying psychology of that. And whole number prices, people seem to put more importance on crossing 36 than crossing 35 and 5/8, or hey, I guess stock prices are in decimals now, huh? So 36 and 2 cents is not as important going through that as going through 36 even. And again, some psychological influence may be at work there. The change in polarity principle is going to tell us that sometimes support levels become resistance and sometimes resistance levels become support. Well, this is getting a little more complicated, but we can certainly draw it out for you here. Here's a stock that's been what we've seen evidence of resistance at 55, right? There seems to be stock that comes out for sale at 55 that drives this price down every time it gets up there. At least we could draw those conclusions from looking at this. Well then, what if we break through resistance? This change in polarity principle says that if you broke through resistance, then that price becomes support. Change in polarity. Some common chart pattern. Here's one that my assistant has done for us, and it looks a little bit like a ghost, kind of, or a mountain, and it may be a head and shoulders pattern. There's often subjective elements to technical analysis. It's got some shoulders here, and kind of a head there. See, that's what we're after. If you didn't see that right off, well, maybe you're just not a technical analyst. But the other formations or patterns we expect to see. double, triple top, that usually means the end of an uptrend. Or a double, triple bottom means maybe this is bottomed out and it's time to buy. An inverse head and shoulders would be this upside down, and the head and shoulders indicates it's about to fall off this shoulder and go down here, I think is the usual interpretation. If we had an inverse head and shoulders, that would indicate it's about to break out to the upside. Now, we've had reversals, we've had changes in polarity, now we've got continuation patterns. When the stock goes into a pattern like this, you see that triangle or that rectangle, and it gets stuck in a trading range, or with the triangle, a narrower and narrower trading range. These are considered by technical analysts to be continuation patterns, that it's just a little fooling around on the way to the resumption of the downtrend in the case of our triangle there, and the uptrend in the case of our rectangle there. And pennants are triangles on short-term charts, and flags are rectangles on short-term charts. So that's a little bit of added terminology for you. The price target for an ensuing trend: measure the size of the pattern and project it from the neckline. So there's our neckline, right? The shoulders on either side, the head in the middle. There's our neckline. Now, the size of the pattern is right there. So our price target, remember that a head and shoulders said we were going to fall off that right-hand shoulder and go down. So our price target is a lower price target, and we've estimated that price target by the height from the top of the head to the neckline. Some other technical indicators that are used besides the patterns: price-based indicators, moving averages, Bollinger Bands. Moving averages. We take a 120-day moving average. We're just taking the average price for the last 120 days. What we use moving averages for is to smooth out some of that noise I mentioned and help us identify the trends. By taking that smoothed average, we can see a trend. Some of the noise is gone. If you take too long of a period, you can wash out the change in trends even. So you've got to be where you're getting some of the noise out to recognize the trends, but still preserving the trends that you're looking for. Bollinger Bands are some volatility estimates, and we go either side of the stock price, like bands, okay? Volatility, and it usually, if it gets up to the top of the band, it heads to the bottom of the band, or if it gets to the bottom of the band, and there's forces at work to drive it back up toward the top of the band. So that's Bollinger Bands that are sometimes used. Momentum oscillators are scaled price measures, and we call them oscillators because either they bounce between a minimum and maximum, like 0 and 100, or they oscillate around a value like 0, 1, depending on how it's been set up. Then we have our sentiment indicators. How are investors feeling? Are they fearful, or are they greedy? Or are they really, really greedy, or really, really fearful? And so from the sentiment indicators, there are opinion polls. Are you bullish? Are you bearish? Put-call ratios. Are people buying more puts because they're scared, or buying more calls because they're optimistic and greedy on the upside? And then there's the VIX. The VIX is a measure of overall market volatility, and we can track the trends on that too. And as investors become more complacent, the VIX tends to go down to low levels, and when there's a lot of fear and uncertainty, it tends to spike up to higher levels. And then we've got our flow of funds indicators, like the ARMS index. That's a short-term trading index, similar to the trend index. And we want to track with the ARMS index is the flow of funds into stocks that are rising in price and the flow of funds out of stocks that are falling in price, and look at the combination of the two. We can look at mutual fund cash. If mutual fund managers have been very hesitant to put cash in the market, they'll have high cash balances, and that also means from a practical standpoint that they'll have to put that cash to work at some time, and that means buying, and so at least it's some ammunition there for an upside in the market without waiting for more cash to necessarily flow heavily into the mutual funds themselves. And equity issuance, back to supply and demand. If there's a lot of IPOs, there's a lot of new shares coming on the market, that just means extra supply, And that usually isn't something that's going to drive prices higher. It's usually additional demand that does that. So here's an example. I talked about the moving average. Here we've got a 100-day moving average and a 20-day moving average. Sometimes technical analysts are going to make a big deal out of when these cross, or when two of them cross, or even sometimes I think when three of them cross. And I'm not sure which it is that makes up what they call a death cross, but I'm sure if you Google it, you can read all about it. So the larger the n, the smoother the average. That's what I was speaking about earlier. So you don't want to smooth it out so much that you take the trends out, but you certainly want to take these choppiness out so that really you can see here we reached a low in the stock here, and then the moving average is turning here. But we can't read too much into this because I think my assistant made up the whole thing. So it's not a real asset. So I don't want to get too involved in trying to interpret this. But you can see this, and I think the technical analysts think that when this 20-day, when this shorter one moves above the longer one, I think that's a bullish indicator right there when we're using this, and a negative indicator when it crosses below it. So we can use various, and different technical analysts use different periods for their moving averages. Oh, I already talked a little bit about Bollinger Bands, but since it has its own slide, we may want to just reiterate that a bit. They're drawn above and below these moving averages by a specific number of standard deviations. So we've got kind of a volatility band on the moving average. And short term, it's contrarian. Sell at the top band, security is overbought, buy at the bottom band. So that's what I suggested they were used for before. I guess I was talking about the short-term use of it. Over the longer term, says you should buy out on significant breakout above the top band. Well, this goes back to a little bit what we talked about with breaking through resistance, and then that turns into an indication of more price gains ahead. So in the longer term, buy if it breaks out of its bands on the upside, and sell if it breaks out of the band on the low side. So that's your Bollinger Bands. Here's an example. It just helps you remember it to see a picture of it. You could see it bouncing off the top band, and well, I don't know if you can call this exactly a bounce, but it did make it back up to here, and we've drawn it as oscillating between these bands because that's the claim, is that it oscillates between these bands with some sort of predictable regularity that you can profit from in the short term, and in the long term, I guess, when it breaks out of these bands is when it tends to extend its move in either the up or down direction. Some momentum oscillators, I mentioned they oscillate between values or around values. Oscillators make extremes of market sentiment more clear. That's what they're used for. Extreme highs indicate overbought conditions. Overbought means high prices, don't buy now, maybe sell short now. And extreme lows indicate oversold conditions. If you're looking to get into this security, that's probably a good time to do it. Convergence, when the oscillator moves with the price trend. So now we're talking about using those momentum oscillators in conjunction with a price trend. And when we get the same signal from both, that's a convergence. When we get opposite signals from them, that's a divergence and a short-term trading signal in a non-trending market. Here's some momentum oscillators here. Here's our price chart. Here's our oscillator down below. We've got an uptrend in the price chart. We've got a downtrend in the oscillator, so we have a divergence. Sentiment indicators. We mentioned opinion polls. I talked about the put-call ratio. I didn't give you an exact value. We just say, well, if the put volume is greater than the call volume, that's negative. And if the call volume is greater than the put volume, then that's positive sentiment. And it's a contrarian indicator, right? The idea is when the average retail investors are buying puts and they're scared, that means stocks are on sale. It's a good time to buy them, and vice versa. So a contrarian indicator means you want to look at what this group is doing or what this indicator is saying and do the opposite. The VIX, high when investors fear the market. Okay. It's a contrarian indicator. When investors are bearish, contrarians are bullish, because the VIX is not forward-looking, it's backward-looking in terms of the volatility that we have seen. So that's what we're saying here is a contrarian indicator, because if it indicates that investors are fearful, then contrarians would say that's a good time to buy. Other sentiment indicators, the amount of margin debt and how fast it's changing, short interest ratio, how many shares of a company have been sold short. So we take the number of shares sold short, divide by the average daily volume, and that's the days to cover. How many days average volume would it take for all the shares that are short to be repurchased in the market? And some flow of funds indicator, I mentioned the ARMS index. We can look at margin debt. Last slide we talked about the change in margin debt, but overall margin debt can have an effect as well. Mutual fund cash position we talked about, and we talked about new equity issuance, and that could include IPOs or secondary offerings by existing companies who just think stock prices are so attractive that maybe they ought to issue a few million shares while the getting is good. Last thing we're going to talk about here, I believe, is some cycles. Technical analysts, and not all of them, it's certainly not all of them use the same tools or believe the same things or use the same methods or come to the same conclusions, but historically this wave theory has been around for a long time. There's a supposed 54-year cycle, an 18-year cycle, a 10-year cycle, the presidential cycle, which probably pretty defensible, that is returns follow a cycle over the presidential years, first year of the presidency, last year of the presidency, etc., with the first and second year being the worst performance, and the third and fourth year before the next election, presidents seem to be on their best behavior vis-a-vis making their constituents happier and wealthier. Elliott wave theory, this is part of the wave theory stuff. Market prices move in interconnected cycles that range from very short term to very long term. So they're waves within waves. People see patterns in there, and they may follow Fibonacci numbers or Fibonacci ratios. Fibonacci series have been found to have some occurrence and explanatory value in nature. Here, they're using them to talk about the length and I think periodicity of various waves over time. So that brings us to the end of technical analysis. I think for the exam that you really need to know most of these terms, know that moving averages smooth things, know that oscillators oscillate, and know what it means to be a contrarian indicator, and certainly something about Bollinger Bands. So happy studying.